Hello, everyone. I welcome all the attendees to the NISM-CFA Institute Stewardship Conclave. SEBI Stewardship Code for mutual funds and alternative investment funds meant to enhance their monitoring and engagement with industry company went effective mid last year. Mutual funds have instituted policies and set up internal processes for engagement. And we thought it would be a good time to review practices and discuss the way forward. We have a detailed agenda today and tomorrow. Today, we will present some research and have a discussion with a cross-section of eminent practitioners. Tomorrow, there will be a strong regulatory focus with a keynote by Sri Ananthabarua from SEBI and David Stiles from UK's Financial Reporting Council. With that very brief introduction, let me hand it over to Dr. Narasimhan from NISM to provide welcome remarks. Over to you.
Good evening, all participants, my fellow panelists and speakers in this program. On behalf of CFA Institute and NISM, I extend a warm welcome to each one of you to this all-important Stewardship Conclave. In my understanding, Stewardship Code prescription appears to be a very efficient regulatory solution for issues and complexities involved in collective ownership. If it's owned by more than one, who is the actual owner, who is going to exercise the ownership rights is always a perplexing question, and it has been very effectively resolved by prescribing Stewardship Code. What we have done between us and CFA Institute is that we are putting together a full-fledged agenda which will be helpful in understanding what we have done so far and what we should be doing with this Stewardship Code for collective welfare and value maximization for all stakeholders in equity investments. What we have done is that in today's program, CFA Institute itself has done some research which will be presented before you. Then we'll present you a 360-degree view of how Stewardship Code can be used or being used. We have panelists from foreign institutional investors, domestic institutional investors, proxy advisors, and even corporates which actually handle this stewardship pressures on them. So we've got a 360-degree view on what's going to happen with stuff, what is happening with Stewardship Code in our country. In tomorrow's program, we have two streams going through. One is that what has been the UK's experience with respect to Stewardship Code. This is very important because UK has taken a lot of lead with respect to Stewardship Code implementation. They have about 7 to 8 years of vintage and experience with this code. So how they have been handling and what is the outcome in the UK? We have what we call Financial Reporting Council talking to us. Mr. David Steele and his colleagues are going to speak to us about their experience. And then regulatory expectations about Stewardship Code is going to be spoken by Mr. Ananthabarua, whole-time member of in charge of mutual fund division in our country. So I think, and then we also will have a presentation on Stewardship Code conducted by NISM faculty, very briefly in terms of how the code has been designed in our country and how has been the mutual fund voting pattern so far and what next has to be done, etc. So I think we have brought together a fairly comprehensive view about what Stewardship Code is happening and how it should be used in our country. And I am very happy to have coordinated with the CFA Institute for this. They have been very helpful in getting us the speakers from the UK, etc. And I am also thankful to each one of you who are participating in this. I'm sure that there'll be enough takeaways for all of us from this conference, and these takeaways will be useful for enhancing corporate governance in general in our country. With these few words, I welcome you once again and hand it over back to Mr. Shivanath for taking it forward. Thank you.
Let me also welcome Mr. Vidhu Shekhar, country head, CFA Institute, to provide a few thoughts.
Thank you, Shiva. Thank you, Dr. Narasimhan, and a warm welcome to all of you who have joined us today in this Today Conclave. It's wonderful to be together with NISM to do something like this, which is very close to our heart and an area in which SEBI is very active and NISM is also very active. CFA Institute has had a very long relationship with NISM, dating all the way back to 2009, when we had only a few hundred members in India. At that time, NISM and CFA Society India and CFA Institute entered into an MOU, and that became the basis for a investment conference, which at that time was hosted by NISM from 2011 to 2013. We came together to do a lot of things together, including workshops on exam development, working with the investment community to promote best practices and so on. Since 2014, when the Institute opened an office in Mumbai, Institute has been doing its own investment conference, and then NISM has its own flagship conference, and both of us are very active separately as well as together. The pandemic slowed us down a little bit, but it's good to get started again, and we couldn't have picked a better area to work together with each other. And I hope that the collaboration that we are starting today on the issue of stewardship is able to contribute in some meaningful way to the way stewardship is practiced in India. As you are aware, the Institute, we are a global not-for-profit membership association of investment professionals. Our members work as portfolio managers, security analysts, wealth managers, and investment advisors, and all the other roles in the increasingly complex investment industry ecosystem. Across the board, we work with in practically every country in the world. We work with the local regulators, with the governments and policymakers in order to promote best practices, in order to promote standards and provide education and so on and so forth. NISM has been doing a great job in that area here in India, and NISM is one of the participants in the Institute's global university affiliation program as well. So I think that this is it's nice that we are doing something like this together, and we hope to work together both on the research side as well as the outreach side, because we need to bring together a lot of different stakeholders in the system. If stewardship has to move from being a tick box compliance exercise to a serious endeavor that actually shapes investment actions and provides benefit to the society as a whole. With these words, I'll hand it back over to Shiva, and I hope to enjoy the program as much as I'm sure you will do. Thank you so much.
Thanks, Dr. Narasimhan. I will present some research from a report on stewardship that we published last year. If I can share my screen. A second.
Yeah, sure. You can share your screen. Just a second, please.
Yeah.
Shiva, now you can share the screen, no issue. You will be able to do that.
Okay, just
so just below the view button, there is a small box. Just click that.
I actually see a full screen mode. Is that the one? View in full screen mode, but that's not.
No, there is an option called sharing on the top. Or you can just press the escape button.
Yeah.
Go to the panel. There is a panel on the right hand side. There is an arrow mark. There is an arrow mark. Just click that on the left hand corner.
I see webcams. I see screenshot. I see. Okay, okay.
You are able to see the sharing option.
You're on mute. You're unmuted.
No, I don't see a sharing option.
No, there is.
Sorry. So I don't see a sharing option, Mr. Krishnamurthy. I see a full screen mode, video unmute.
Okay, sir. Just a minute.
Can we do this way? Like, can we NISM share this slide and move as
Now can you please,
Shiva speaks?
Shiva, can you please see now? Mr. Shiva.
Okay. Excellent.
Yeah, please.
Excellent.
Yeah.
All right. So can you see my screen?
Just a second. Can you please put it on? Maybe it is on the way. Yeah, put it.
All right. Can you see my screen?
Yes, we can see it now.
Yes, very well. We can see. Please carry on.
Sorry.
Just
it has to be put on the slideshow though.
Full mode, you can put it on the slideshow mode. It will be visible much
better.
The third option on the top. Third tab. Yeah, or otherwise there, correct.
in display setting, just click under display setting. And there are 3 dots here.
Okay. All right. All right. Is that okay?
Fine. It's fine. It's working. Please carry on.
Excellent. Sorry about this. I guess it's one of the downsides of virtual this thing. Sometimes you get unexpected technical challenges. So why don't we just jump into this, right? So I want to just present a little bit on our report on stewardship. We focused on Asia Pacific markets, and we kind of looked at some of the regulations as well as practices around stewardship. So this is the outline for my brief remarks. So we will look at stewardship in Asia Pacific, background trends and way forward. We will look at some of the survey results. So we surveyed our members on things like what is their level of awareness on the codes and what is their experience with stewardship and so on. I thought I'll present some of those practices. I do want to kind of touch upon the relationship between stewardship and performance, because a lot of the conversations are around, like, does stewardship add value, right? So I think there was an interesting recent academic study. I won't get too much into it, but I do want to just touch upon what they did. And I will finish up with broadly what are the stewardship issues that are on the minds of practitioners, which will be a nice segue into the panel discussion that follows. Stewardship codes, what are they? So the objective of the stewardship code is to motivate institutional investors to act as responsible owners or stewards of capital, engage with portfolio companies, but more importantly, the purpose of stewardship is to generate long-term value for beneficiaries. So typically, the components of stewardship codes everywhere in the region has things like establishing a stewardship policy, which in turn talks about what are the objectives for those asset managers when they pursue stewardship, right? So some of them pursue, like almost all of them pursue long-term value creation. Some have explicit objectives around ESG or corporate governance. Other components are managing conflicts of interest, engaging with investee companies. How do they engage with investee companies? I think putting some processes in place, disclosing voting policies and reporting. Now, these some of the components vary across regions, and we will see that in the subsequent slides. Good stewardship. Why is it important? Now, the main purpose of stewardship, like I mentioned, is value enhancement or creating long-term value. But when UK, which is the first market to come out with a stewardship code in 2010, the context was different. So UK was coming out of like UK and the rest of the world was still coming out of the financial crisis, and there was a lot of hand-wringing, right? What went wrong? The banks had to be bailed out, institutional investors suffered losses, and so on. There was a lot of hand-wringing as to what can institutional investors do better. So the stewardship code kind of like, came out of that context. So the principal focus for UK stewardship code, at least at the start, was risk management, right? Now, when these stewardship codes, like, gathered steam and started, like, appearing in like many other jurisdictions in Asia Pacific, the focus once again shifted, and the focus was more towards fostering best practices in business management and corporate governance. Even SEBI, when it came out with the stewardship code, it outlined the main principle is like, promoting good corporate governance in India as one of its main objectives, right? So I guess what I'm trying to say is, on surface, like, the motivation is value enhancement, right? But depending on the context and the times, the focus has also been on other objectives such as risk management or corporate governance and so on. More recently, as ESG is becoming popular, the purpose of stewardship is once again shifting towards, can we promote a more sustainable economy through engagement as well as investments, right? So ESG is becoming once again a new context for like institutional investors to engage with companies. So now let's look at the institutional investment ecosystem. Now, SEBI's stewardship code focuses on mutual funds, which are asset managers. But asset managers are only one part of the investment ecosystem, which has companies at one end, through asset managers, asset owners, like pension funds and insurance companies and others, to the ultimate beneficiaries, right? Now, most of the initial codes on stewardship focuses on asset managers and asset owners, but increasingly service providers are also coming into ambit, and that we'll see as part of one of the trends. Now, the point is, when asset managers, asset owners engage with asset managers, or when asset managers engage with service providers, there is always a risk that the selection as well as management, like the relationship, might be based on costs, right? So like if everyone tries to reduce the cost, asset owner tries to reduce the cost incurred from asset managers might choose service providers like consultants or proxy advisors and so on based on cost, even at the expense of the value or the long-term value that these service providers and others might bring in terms of stewardship responsibilities and so on. So there is an increasingly trend towards expanding the scope of stewardship towards these other parts like asset owners as well as service providers. Now, this chart basically charts the development of stewardship codes in Asia Pacific. The first stewardship code, like I mentioned, started in the UK post-financial crisis. But it started picking up pace in Asia Pacific after Japan came out with its own stewardship code for principles of responsible institutional investors. And Malaysia, the same year, came out with this code for institutional investors. Now, since 2014, a lot of markets, including the financial centers, Hong Kong and Singapore, as well as other jurisdictions, have come out with its own stewardship codes. So it is like, the codes have really picked up pace in the last 5 years, so to speak. So like you see that India Stewardship Code, which came in 2019 and which went effective in 2020, is one of the last major market to have a stewardship code for mutual funds. Now, clearly, India had stewardship codes for other institutional investors like pension funds and insurance companies before 2019. Now, this just lists out the different stewardship codes in the region. I won't go through all of it, but I want to highlight a few things. Now, the code sponsor for these stewardship codes need not be just a regulator like SEBI. It can be an industry association, like in Australia, they have separate stewardship codes for asset owners, Australian Council of Superannuation Investor, the second row, as well as asset managers, which is the Financial Services Council. Now, it can also be stock exchange in some cases like Taiwan, which is last but one row. So it can, like the stewardship code sponsor can be a regulator, an industry body, or a stock exchange. The application of code could be voluntary or a comply or explain or mandatory. So SEBI code is mandatory, but most of the codes are comply or explain or voluntary code. Now, the last concept is signatories. Some code sponsors allow the firms to sign up as a signatory to the stewardship code. Typically, when there are signatories, it is important whether the largest asset owner signs up. So typically, the market looks to the largest investors signing up to the stewardship code in order to see whether that stewardship code will have legs or others will follow suit or not. The other point about signatories is that some of these signatories also undergo yearly review. So it can't be the case that an asset manager who signs up as a signatory will always stay on if he doesn't adhere to some of the principles of those stewardship codes. So I'm just trying to give you a flavor of how these codes work in practice. Next thing I want to talk about is some of the key trends. I touched upon a few of them. Sustainability and ESG factors are increasingly featured in stewardship codes. UK and Japan are prominent examples which have ESG specifically mentioned as part of their stewardship codes. The stewardship codes are expanding to other asset classes. It started out with equities, but increasingly fixed income and private equity are also covered under stewardship codes. In India, like it's mutual funds and alternative investments vehicles. Stewardship codes apply to a broader set of stakeholders. I said that proxy advisors and investment consultants are increasingly coming up within the ambit of investment stewardship. So it's not just for asset managers and asset owners. And the last one is also important. So I think Bidu in his initial remarks talked about, it can't be just a compliance thing. The focus needs to shift towards outcomes. And that is a trend that we are increasingly seeing in the market. So there is a lot of focus on outcomes-based reporting. It is not just a question of having a policy and just reporting on activities. You also need to demonstrate what kind of outcomes you are looking for and what kinds of outcomes you are trying to achieve. So that's those are some of the trends we are seeing. And I'll just, so this section, I conclude with, what our findings are before we move on to the next section. So the way forward for, at least in our report was that we encourage an outcome-focused establishment and update of stewardship codes. Right? So that's our, that's the main thing that we are, encouraging regulators as well as, market participants. We generally encourage comply or explain to promote some flexibility. But I think in India we have a much more stringent mandatory regime. We also encourage the code sponsors, whether it's regulators or industry body, to promote and build awareness around stewardship. It's not enough to kind of have the requirement, but there is also a lot of trainings and awareness building needed. So we do think that there should be some global best practices, but there should also be flexibility to cater for market differences. We have seen that a little bit in some of the proxy voting policies. So let's say an asset manager, a global asset manager, will have some global proxy voting policies, but for an individual market, he might tailor potentially, let's say, the thresholds of what he's willing to accept, right? So just to take an example, right? So gender diversity, right? So a global asset manager might say that globally he would like to have at least 30% gender diversity on boards, whereas in a market which is just early and starting out, the threshold might be lower, right? The next one is the exercise of leadership from top. And it's important for asset owners to kind of take the lead. Although I think we will hopefully be seeing some of that in India too. And we do encourage inclusion of sustainability and ESG in stewardship codes, but I think in markets, some markets, it might take some time. So this concludes just our broad overview of how these regulations and codes are implemented in the markets. I just want to take a pause and see if there are any questions from the participants.
Shiva, I have a question. I'm Narasimhan here.
Okay.
May I ask you a question, Shiva?
Please.
Yeah. India, we have taken a view that they should be mandated, and we focused on mutual funds for this implementation of stewardship code in some form. Yes. Whereas I see that various jurisdictions have made it more a voluntary, more benign kind of a structure.
Right.
In your view or in your research, did you find that stewardship code actually, in fact, has helped in some form in terms of protecting the investors' wealth? Is there any report, any study on this? If so, can you please throw some light on that? Thank you.
Yeah. All right. So I guess so I see it as two parts, right? So one is is it more effective to do a mandatory, or is it better to give some flexibility? The second part is does stewardship have an impact on investor outcomes and so on? I think the second part, we have some, I'll talk about in terms of an academic study later in the presentation. But to your first question, right? So I think, the overall regulatory context in India, a lot of these things are mandatory, right? But in our view, I think it's a good thing to have some minimum standards and make it mandatory. So I think I'm just taking a parallel example here, independent directors, right? So I think if you want to have a minimum threshold, or potentially if you want to have women representation, just to have some minimum standards probably helps. But if you want, those codes, whether it's corporate governance or stewardship codes, to be implemented in spirit, I think it will take more than simply rule making, right? So you need to start promoting, building awareness, and I think that's the focus of the kind of workshops that we are doing today and tomorrow, right? So you need to have a little more discussion for people to kind of truly adopt and make sure that it's not a compliance activity, but it's also it's adopted in spirit. All right, so I'll quickly move on to just talk about a few survey results. Now, unfortunately, our survey was done before the the survey was initiated before SEBI came out with the codes, so we did not cover India. but I still think that we covered similar markets, like in the region, like Malaysia and Thailand, and similar markets in similar stage of evolution. So the results are like hopefully representative, right? Let's just, with that caveat, let me just say the purpose of our survey of our CFA charter holders was to gauge the degree of awareness and application in the region about stewardship codes, the effectiveness and influence on the integration of ESG factors, and how the codes could be improved. So we surveyed a few markets, like I mentioned, some of the developed ones like Australia, Hong Kong, and Japan, and some of the emerging ones like Malaysia and Thailand. So our first this thing is, at least when we did the survey in 2020, across the region, there was little or no understanding of stewardship codes in the markets they invest in. So 42% of our respondents, they did not have a good understanding of what the stewardship codes contain, right, in their respective market. There is also only 28% of respondents said that they understood stewardship codes well and very well. So which kind of makes the point, like, I mean, if it is true in India, then it makes sense that we should conduct some of these sessions like we are doing today, just to make sure that people understand what's the purpose of, investment stewardship. So we also see that some markets had more evolved compared to others. For example, Japan, which started its stewardship journey in 2014, had 56% of respondents saying they have a strong or very strong understanding. So I guess it's a question of matter of time for people to get a degree of understanding of what these codes are about, but also about trainings and awareness building. The second part, we asked what are the potential implementation challenges when it comes to stewardship code. 38% of our respondents said that they were skeptical of the link between engagement and value creation. So, and 36% said that it is costly to engage, right? So high cost of engagement, and they were skeptical about the value between stewardship and value creation as the top reasons for as implementation challenges. Now, I hope that we will talk about some of these issues in today's panel discussion, and we'll get to some more degree of understanding. We asked participants what is the impact of their engagement activities, right? So, of course, there were people who said that they were skeptical, but we asked them where do they see the greatest impact for engagement. Now, 63% of our respondents said that governance is the area where they see strong or very strong impact, which I think must be true even for Indian markets. Like environmental, social, or simply an economic or value creation perspective, right? So just to get a sense of what the company is doing in terms of strategy and all that stuff. So these had lower numbers in terms of what our members thought had the impact potential for. So when people think about stewardship, they are thinking about what is the potential impact on governance. And finally, we asked some very specific questions. What is the typical engagement frequency with portfolio companies? So like most of our respondents said that they engage with their portfolio companies quarterly. 19% said they engage with their companies more frequently than quarterly, which is fairly frequent, right? And 17% said they engage with their company once a year, right? So, or annually. Only 13% of the responses were they had limited engagement or there no engagement and so on. So what this means is that our respondents, it's not that they don't engage with companies, right? It is just that awareness of stewardship codes or what are the principles in their stewardship codes within their market and how what are the components of those stewardship codes. I think that awareness is still a little low. It doesn't mean that the respondents don't engage with companies per se, right? So even today, I think even before stewardship codes, investors did engage with companies from on issues and so on. And lastly, we asked them what is the estimated percentage of companies that the firm, your firm, asset manager, engaged with. So 24% of the respondents said that they engage with between 10 and 25% of their company. So essentially, if you have 20 companies, so you potentially engage with about 5 companies, right? So for an active fund, so to speak. And 23% said that they'll engage with less than 10% of the company. So there are two parts to it. What percentage of your portfolio do you engage, and what is the frequency of engagement, right? So most of them, they engage less than engage with less than quarter of their investee companies. Now it is not surprising. We don't expect asset manager to invest, to engage with all the companies in their portfolio. So for example, if an asset manager owns only 1% of his portfolio in a particular company, we don't expect the asset manager to engage with that company as much or much at all compared to his top holdings and so on, right? So it's just an expectations of how much you are expected to engage. So that's the survey results on practically how does engagement happen. Just to finish the discussion, we also asked the members what were the methods of engagement. So regular management discussions came out on top, 41%, right? So these management discussions could be some of one-on-one discussions or discussions through investor meets and so on. Active proxy voting was the primary mode of engagement for 37% of respondents. 22% also said that they make presentations to management. So it's not so much about sometimes the interaction could be simply investors coming to the company and telling them what they think about the issues of those companies are, right? So that could be just a way of engagement. So that's the the survey results, which some of the survey pointers, which I thought was pretty interesting. So this covers the survey. The first thing covers about the trends. So I will round off with how engagement works in practice through an academic study. Now, there aren't much research on engagement. I mean, so some of the research questions, academics are generally interested, is that how do active managers actually engage with portfolio firms? I mean, other than the superficial, we have regular discussions. How do they actually engage? How do they integrate stewardship in their investment process? And what role does monitoring and engagement play in fund managers' trading decisions, right? The whole purpose of engagement and stewardship is to kind of make those decisions about those companies, right? These are all pertinent questions. There aren't many studies about engagement because these engagements are private, right? And therefore unobservable. Now, recently there was a study, this is a 2021 study from ECGI, European Corporate Governance Institute, benefits of access, evidence from private meetings with portfolio firms. What they did was they went to an asset manager, Standard Life, now called Aberdeen. They got proprietary data of all the internal meeting notes, as well as voting decisions, as well as trading decisions for a period of 8 years, right? So 2008 to 2015. And they analyzed it threadbare just to figure out what did the meeting notes say, how did it influence voting, how did that voting influence their trading decision to sell, and what is the impact of those trading decisions on performance, right? So there is a long chain to it, right? It's not simply you don't vote against just like that. Typically you expect to engage with the companies and see if you can change their minds or things like that. And you don't just sell. Sometimes these selling decisions are influenced by your vote. You might decide to exit the position and so on. The study showed that engagement with target firms generates insights and information advantages, increases trading, and is associated with significant abnormal returns, right? So engagement is associated, so like the period around engagement is associated with trading, and those tradings is associated with significant abnormal returns. So that's the headline, right? But I won't like get into the numbers, right? So sometimes I think a story is always better than numbers. So I picked one story from the paper, and I think you can access this paper online, the benefits of access paper. But I'll just highlight one story, right? Now, Carillion is a UK company which is into, I think, infrastructure. Now, in 2015, the analyst, governance specialist, met with the chairman of Carillion, all right? And this is his meeting notes. But for simplicity, I'm just going to read it, right? Looking unfeasibly tan for this time of the year, he had just returned from Lesotho by way of a break at Spa in Thailand. He had been in Southern Africa as the chairman of Children's Charity. The chairman had a busy time and justifiably proud of the polo match the charity staged. Meanwhile, he remains chairman designate. When the analyst asked the outlook for Carillion, he seemed rather vague. He said he had an intuition that there were opportunities in developed and developing economies and so on, right? I mean, like, I don't want to read the whole thing, but after 2 weeks after this meeting, the analyst, like, of course, this was just one of the inputs, changed the recommendation for Carillion from buy to sell, and all the funds of Standard Life sold their positions in the subsequent few months, a few weeks, so to speak. They didn't, like, you don't trade out immediately. Over the next few weeks, all the funds closed out their positions in Carillion. Now, Carillion went bankrupt 2 years later, right? Now, I just want to highlight this as what's the value of engagement, right? So we can talk about numbers and trading decisions and alpha and all that stuff. And the paper has a lot of it. I just want to say that, engagement has value, right? So you can, like, and by the way, Standard Life, like, had about 750 meetings with their portfolio firms over that 8-year period, right? So it just happened that one of these meetings yielded a significant insights that they staved off their losses, right? So it's not a fluke. You need to kind of continually engage, and that's where the value is going to come from. I will close my remarks with just stewardship issues in India, which I think is a nice segue to get into the panel discussion. So now last year, after the stewardship code came into being, so the CFA Institute, what we did was we brought together a set of fund managers and CIOs of mutual funds, and we asked them fairly simple questions, right? So you are supposed to now, like, practice stewardship. What are the things on your mind, right? So what are the concerns? What are you thinking about when you're, like, going through this exercise? Now, some of the issues that people highlighted were, like, I wouldn't read out all of it, whereas what is the balance between engagement versus private briefing regulations? So SEBI, I think, came out with the proposals, but not final, that private investor briefings with companies, there probably needs to be some disclosures, right? So you can't give what do you call informational advantages to like institutional investors and so on. So I think some fund managers said, like, what does it mean for stewardship, right? So on one hand, you want us to engage. On the other hand, like you are saying that, look, these engagements give selective advantages, so there needs to be all these disclosures and so on. So they had these kind of questions, right? There were questions around engagement threshold and factors. They had questions like, what is the level at which you engage and what's the point at which you sell, right? So there were questions around that. Role of proxy advisors and in-house decisions. So which was like, what's the, like, how much should you outsource and what stage you should bring in those decisions about companies. So these are some of the questions. So like I said, I won't get into all of it, but so that's provides a nice segue into our discussion with that will follow. So that concludes my presentation. If there are any questions, I'll be happy to take one or two now.
I have one question, Shiva. Whether there was any concerns in your survey, either in India or outside, when some mutual funds work together collectively to engage with the company, investee company, concerns of persons acting in concert, action in concert, that kind of a question, whether it came up anywhere is a question.
That's a really good question. So, like, people acting in concert rules are like, I mean, for just for like the benefit of everyone. So, acting in concert rules are if you engage, very deeply with companies, then you are deemed to be people acting in concert, which means that you will be facing additional restrictions on trading, as well as additional disclosure requirements, right? So, so I think so. This issue also came up in some of our discussions. I think the point is it's a like. So it came up in the question of collaboration with other investors, right? So acting in concert rules also require having some degree of ownership, ownership in those companies, and which comes into play if you're collaborating with other investors, right? So your combined stake could go up, and you might be deemed as persons acting in concert. But one of the responses we heard in the roundtable, some of our previous discussions, are that investors have typically work with the so-called investment collectives, like Climate Action 100, or in the region they work with ACGA, Asian Corporate Governance Association, and so on. So these collectives are a way to work in collaboration, but not but you are not actually these associations are the ones who pick up the topics and so on. It's a way to manage that tension between collaboration and like not getting into these issues of acting in concert.
That has been very helpful. Thank you, Shiva.
Yeah. All right. So if there are no questions, I will stop sharing. Stop sharing my screen.
Yeah.
And
so I'm just making my screen visible, Shiva. So you are able to see it. Yeah, you can
yes.
start now. Yeah.
Yes. Thank you so much. So for the next part of our discussion, I would like to welcome our panelists. So the first one is Mr. Kanchinathan Parvathisan. He's the company secretary and chief legal officer at Tata Steel. His most significant responsibilities include advising the board on governance and ensuring that the members of the board are ably equipped with resources to discharge their fiduciary duties. Welcome, Mr. PK. Our next panelist is Mr. Harsha Upadhyaya. Mr. Harsha Upadhyaya, CFA, is heads the equity fund management team which manages more than 55,000 crores of assets at Kotak AMC. And he manages funds such as Kotak Standard Multicap, Kotak Equity Opportunities, and Kotak Tax Savers. Harsha has over 2 decades of experience over equity research and fund management, and he has stints with companies like DSP BlackRock, UTI, and SD Asia Securities. Welcome, Mr. Harsha. Our next panelist is Mr. Jain Gupta. Mr. Jain Gupta is the founder and managing director of Stakeholders Empowerment Services, a not-for-profit corporate governance research and advisory firm. He has ultimate responsibility for all aspects of firm strategy, team, and operations. Mr. Jain Gupta is one of the stalwarts of India's corporate governance. He has over 43 years of experience in public and private sector, including 2 terms with securities market regulator, SEBI in India. Welcome, Sri Gupta. And the last panelist is Mr. Paul Milon, Head of Stewardship Asia Pacific at BNP Paribas Asset Management. Mr. Paul is passionate about sustainability issues and believes investors can play a critical role to tackle challenges such as climate change. In his role covering Asia, he's convinced that we can promote greater adoption of sustainable investments through raising awareness on ESG challenges. So we will speak to you all about some of the sustainability-related issues with stewardship. Welcome. So that's like our panel. Do we have Mr. Jain Gupta on video?
Yes, sir is available. Sir is available. You won't be able to see him. You can please continue.
Excellent, excellent. Welcome, everyone. So why don't we just get into the discussion. So let me start with Harsha. So the stewardship code is for mutual funds, and I felt like it's better to start with the mutual fund manager first. So Harsha, can you talk about Kotak's stewardship objectives, as well as what are you trying to achieve through engagement?
Yes, Shiva. As far as Kotak Mutual Fund is concerned, obviously we come under SEBI guidelines for all our investment-related activities. So to that extent, stewardship code is mandatory for us, just like for other mutual funds. But to just elaborate on that, we didn't start when SEBI actually put in place these regulations. In fact, we started our ESG or stewardship journey way back in 2018. When we became the first asset management company from the country to actually sign up for UNPRI, which is the voluntary network of institutional investors who believe that the investments have to be in a responsible way and it has to make money on a sustainable basis. That's when we started our journey. Thereafter, we have also been signatory to Climate Action 100 Plus, which is again a global voluntary initiative in terms of engaging with companies which have one of the highest greenhouse gas emission levels, and how to kind of guide them and bring them towards more focused efforts on maintaining climate and environment. So these are some of the things that we have been doing. But clearly, stewardship code, which is mandatory for all mutual funds, is also applicable to us. And simply put, what we do is to monitor and engage with our investee companies on a regular, ongoing basis on various issues related to financial performance, operational performance, company strategy, capital allocation policies, governance structures, and various other ESG related issues. So broadly, these are the things that we do. And essentially, it is to make sure that since we manage money of minority unit holders, and those interests are protected in the corporate environment is what we try to do.
Excellent, excellent. I think, so in India, I think very few asset management firms are signatory to PRI. So I think that's very progressive. Let me move to the other side of stewardship, so Mr. PK. From an issuer perspective, can you talk about what's the value you derive from engagement and stewardship?
Sure, thank you very much. Yes, as an issuer, stewardship is certainly important for all of the issuers and certainly for listed entities for broadly 2-3 reasons. One is, of course, while companies do require legal license to operate, now we also need the social license to operate. We are not operating in silos. We do work within the community, and particularly companies like Tata Steel, which is in the metals and mining industry, and this industry is a hard-to-abate industry. So obviously, you will need a whole lot of support from the community to operate. So obviously, the social license to operate is as important as a legal license to operate, which is in the form of consent to operate. So that's my first, that's one of the significant reasons why it becomes very important to focus on stewardship from a business perspective and issuer perspective. Second is, I'm a student of law and governance. And if you look at the way the law has evolved or the governance practices has evolved, both globally and in India, the purpose of the corporation itself is changing. I think gone are those days where purpose of the corporation was just to maximize wealth for shareholders. Now, probably the purpose of the corporation is actually moving towards creating long-term value and particularly long-term sustainable value for stakeholders. So, and of course, you've been seeing SEBI and both SEBI and Ministry of Corporate Affairs in India take a lot of initiatives, and they have been proactive, in fact, far more than their peers in the West, because India is one geography where the role of the board and the duties of the board actually is to the stakeholders and not just the shareholders. Likewise, if you look at the disclosures and reporting, SEBI has actually gone beyond what generally companies are required to disclose in the form of financial statements. Now, if you look at the recent circular on BRSR, we've gone, I think, far ahead into the future. So even from a law and governance perspective, stewardship makes a lot of sense. And of course, as I said at the beginning, even otherwise, you do need social license to operate, without which you just can't be successful.
So we will get into some of those aspects as we move along. But let me quickly move to Sri Jain Gupta, and to just provide a proxy advisor perspective, right? So I think in our presentation, we spoke that some of the jurisdictions also cover proxy advisors as part of the stewardship ambit, right? Other service providers. But even otherwise, proxy advisors, in recent years, they have become an important part of India's governance landscape. I would think the last few years since the mandatory voting rules came into picture. But with the stewardship code becoming effective, Mr. Jain Gupta, if I can ask you, how do you see the role of proxy advisor evolving? Hello, Mr. Gupta, you might be on mute. Hello. Hello.
Yeah, can you hear me now?
I can hear you.
Okay. See, so as I say, thank you, Shiva, first of all. I see the proxy advisor is a very small part of the entire ecosystem of governance and stewardship. Why I say so? Because we never see ourselves as the active participant of the governance. We are only the knowledge and input provider, because ultimately the decision making is with the asset manager. So we will never see ourselves as a roller in the role of an activist or playing a positive role in the sense. We will only provide unbiased information to the asset manager and let the asset manager decide. Because the day we become a decision maker, it will be wrong because we have no stake. We are neither responsible for the performance of the asset manager, nor we are having money from the investors. So we will always see, but I have seen over a period of time, especially because I have no experience on what is happening all around the world, but especially in India, when we started back in 2012, nobody knew us, nobody wanted to talk to us, and even if we wanted to talk to somebody, they will say, get lost. But today the situation is that the companies are eager to know what is our recommendation. They will call us and say, what are you doing, when the report will be available, if you need any clarification, please let us know. So these things have changed, and these things have not changed because of us. I will never take credit. Things have changed because of the regulatory landscape that has happened. That is one, because SEBI and MCA have made a lot of changes. The second thing is the pressure from the investors themselves has come. So I would say the every element in the ecosystem is working towards this. And as far as the stewardship is concerned, Harsha is also there, who is also my client. We have started providing inputs for stewardship activity. That what are the changes which can trigger your stewardship activity, and that the asset manager can rate them into A, B, C, or critical or non-critical or important, non-important, and carry on this thing. So we are only the knowledge provider. The decision making will always remain with the asset manager, and we will never want decision making to come to us.
Got you. But that's the valuable aspect to it, right? So to focus your stewardship activities through means of research and, like you said, some triggers to be able to focus your limited resources. I suppose that's the the value that proxy providers can bring in. We'll get to that, but let me get some initial comments from Paul Milon. Paul, can you talk about your stewardship objectives, right? So you're an international investor. What are your stewardship objectives, and what are the outcomes you're targeting for each?
Yeah, thanks a lot, and happy to be here today. I hope you can hear me well.
Yes.
Yeah, perfect. So stewardship is one of the key pillars of our sustainable investment approach. So at BNP Paribas Asset Management, since 2019, we took the commitment to apply a firm-wide approach to sustainable investment, meaning that for all of our portfolios, we would integrate ESG, have an active stewardship and engagement approach, apply our exclusion list. And the fourth pillar is actually where we direct our stewardship activities, where we identified three key themes, which we call the 3 E's, which are the energy transition, environmental sustainability, such as protecting biodiversity, and equality and inclusive growth. So in terms of our stewardship activities, they would be aligned with these 3 E's. For instance, on climate, they would be related to some specific focus that we have on low scoring entities. So when companies have a low ESG score, we try to engage with them on areas that we find for improvement. They would be related to our responsible business conduct, so more our exclusionary approach. Before excluding, we want to understand better, what the company is doing, how it's working to improve some of the issues that have come up. And it may, of course, be related to the proxy voting. For instance, we have some expectations around gender diversity at the board, and we would be contacting some of the companies that are still a bit short of our expectations, but which we believe have scope to go in line. So all these would be the kind of panel of different stewardship priorities that we would have, particularly in the region.
So we'll get into some of the approaches, but let me Asha. So I think Paul talked about the 3 E's and what are his topics and so on. Can you talk about your topics? Like, what are the topics you like, or how do you identify your engagement, either through topics or which companies to engage?
Shiva, it's a good question. What are we trying to do through stewardship activity? It is essentially we are trying to create a bridge between our unit holders and the investee companies. So whatever is relevant for our unit holders in terms of management of their money in the most sustainable way, is something that we need to do and monitor and engage our investing companies in that respect. That is exactly what we do. And the issues could be very, very varied depending on which industry you are looking at, which company you are looking at. But essentially, if I have to summarize in terms of the kind of topics or the issues that we are really concerned about, is the entire financial performance. It's not that I mean, for every company, it's the same set of questions that we ask or do stewardship activities with. But let's say a company suddenly, which was growing at a certain rate, starts to come off in terms of overall growth rate, despite industry being good in terms of overall demand supply dynamics or the cycle perspective. It could also be the financial performance in terms of margins and overall profitability. There could be very, very different changes that we have seen in a particular company. That's also possible. It could be just operational performance in terms of how a particular plant has been working. And there could also be material risks coming from environmental, social, and governance factors. So those are some things that are going to be more and more critical as we go forward. And that is something that we focus on. And then essentially what we are interested is in terms of looking at company strategy and its capital allocation policy in the overall board structure and the governance structure, so that if these broad decisions are taken in a proper way, then most certainly we would see a retail investor interest is being protected. So that's what we try to do in our stewardship activities. And again, it's not that we will be able to do same kind of intervention with every investee company. So we have got various levels of intervention, whether we want to engage at a particular frequency, or whether we want to engage with all companies in the portfolio or not. These are some of the decisions that we need to make at the fund house level. And we have got a internal framework to look at various companies in various baskets, and we go about our stewardship activities from that perspective.
Got you, got you. So from what I'm hearing, it's a lot of it is basically value enhancing, right? So to like what materially impacts the value of the company in terms of, where it's in the cycle and potentially what the strategies are evolving and so on. I also heard a little bit about the environmental dimensions and do you engage with them on governance matters, if I may just ask that pointed question?
Yes. Corporate governance issues are always tricky, and those are the issues which are more often discussed with the companies. I mean, I must point out that over a period of time, now there is some sort of an understanding with Indian corporates as well that some of these governance errors can be really harmful for the overall standing of the company in terms of its brand, in terms of how they can create wealth, which also affects the majority shareholder more than minority shareholders. So to that extent, I think companies have been more open to discuss some of the issues. When we started out our stewardship activities, obviously things were more difficult, I would say. But as time has progressed, we have seen a lot of companies on their own reaching out to us before some critical decisions are taken to engage and see whether those are in line with what minority shareholders are expecting, etc.
Got you. Okay, I'm tempted to pick up on that last point. Let's say one of the issues which like I mentioned on in my last slide is engagement versus private briefing and all that this thing, right? So you mentioned that companies reach out to you before they kind of make an important decision and so on. So how is that beating like managed, right? So I mean, there is always the risk that some price sensitive information might get passed on, like if they are debating an important decision and so on. Can you talk about how that thing is managed when that happens?
In the current scheme of things, the meetings that we do during market hours with corporates are all recorded. So we keep a record of what meetings have happened and what have been the discussion points in those meetings. And also our ESG team puts out notes after every meeting to minute the discussion that has taken place with the company. Until now, we have not faced an issue where there is a dilemma in terms of whether we can, use that for our investments, etc. These are mostly longer-term issues that companies would want to check with us. There is nothing which determines performance of the stock or the business in the very short term. So to that extent, we are extremely careful on that. And even if there is a little hint in terms of something which could be construed as something which is sensitive, then we really do not act on those information. That's what we do.
Okay.
Yes, it's a gray area, but I think we will have to put our hand on the heart and listen to it, whether it's the right way to go forward in terms of investments or not.
Understood. Thank you. So let me move to PK. So what's the we talk about importance of stewardship and so on. For a large corporate like yours, how is the oversight of stewardship structured? In the company.
Yeah, thank you, Siva. So for a large corporate, and of course for any corporate, certainly stewardship needs to be owned up at the top, because these are not matters which are bottoms up. These are generally, top down. So the culture needs to be set right at the top, both at the management level, which means the CEO or the managing director needs to own up. And of course, the board, which oversees the performance of the management, also needs to be very sensitive to the changing trends and the expectations of not just investors but other stakeholders with respect to the stewardship responsibilities. So obviously now I think, like Harsha mentioned, at least I see in large corporations and probably some very good, well-run smaller corporations, I think the role of the board and most of the committees is well understood. You will actually find the stewardship responsibilities being overseen by a few committees, like certain of the governance related aspects like succession and remuneration is taken care by the nomination and remuneration committee. Matters relating to environment and health and safety actually typically goes to a safety, health and environment committee. Things relating to society actually goes into the CSR committee. So I guess the structure, the governance structure is now more or less quite well laid out and quite well understood, and particularly for listed entities. And that's what we are speaking here, because the stewardship code on the other side is for the mutual funds which do invest in listed entities. Risk management is becoming a very, very important topic. And most of the companies do have a full-fledged risk management committee where the business and operational risk, particularly, and of course, the ESG risk, and now the cybersecurity risk. These are things which are being very well discussed. And I think most of the companies do focus on many of these things. And risks arising from the financial aspects do go into the audit committee. So I think there is a clear understanding of the governance structure, and I think India is quite focused on these things, and that's what is my view.
Got you. Since you mentioned do you also have this stakeholder engagement committee, which is which
Yes.
I've seen in some, not others, and so on? Do they have any kind of on the other side a stewardship responsibility, or is it handled separately?
So that's a good question. While the stakeholder relationship committee is more compliance driven as against mostly strategic, because what has happened is the way it evolved, the stakeholder relationship committee, the way it evolved was, it was called the investor grievance committee. And that's how, while the name nomenclature has changed, predominantly the nature of work has not really changed. But as I said, there's going to be a lot of overlap if this committee were to take on the other things, because as I said, the NRC and the CSR committee and of course the RMC and the audit committee does a lot of work relating to stewardship. So while Stakeholder Relationship Committee focuses mostly on the compliance related aspects and corporate actions related actions with respect to investors.
Got you. Got you. Got you. Yeah. If I move to Mr. Gupta again, Mr. Gupta, you have a very like 50,000 feet view of what is going on in terms of voting and like issues and things like that. From your vantage point, in terms of voting patterns, right? So, what are the issues Indian institutional investors are increasingly focusing on?
Yeah. Okay. Thank you, Shiva. See, what we have observed for last 8 or 9 years, the first thing that we have observed is that the voting percentage has increased tremendously from 2012 to 2021. There are two reasons for it. One was this, that earlier when the physical meetings were there, so most of the time it was no show for the investors because of various factors, because the location of the meeting and bunching of the meeting together and resources. And when you hold 10,000 shares, you don't go to Timbuktu to attend the meeting. That is one aspect. So that means e-voting has changed the whole game of the voting from zero to hero. That is one. The second thing is the SEBI and IRDA and NPS mandate that the funds have to vote have also changed this thing. And lastly, what has happened, the last year mandate of SEBI, that abstain is no longer a choice for you to vote. So either you have to vote for or you have to vote against.
Right.
So that has also changed a lot. So we have seen a lot many changes in the voting pattern of institutional investor. That is one part of it. However, we have yet to see any change in the voting pattern of the retail investor. Retail investors have not been voting, although there has been a very slight increase because some HNI have started voting. But the problem, and whenever we see the retail investor voting percentage is high, you can be rest assured that those retail investors are either proxy for promoter or proxy for a institutional investor. Because if out of 100 companies, only in 2 companies retail investors are voting 99%, it is almost impossible that those are the real retail investors. Having said that, then if you analyze what has been the voting pattern and where the itch is happening to the institutional investor, one is on the remuneration, other is on the related party transaction, and some extent third is appointment of or reappointment of directors. That is the 3 broad areas that we can say that the voting have, the investors have shown their dissent or shown their anger or displeasure in most of the cases. And the other thing is this, that when you see, when we say that high voting percentage against the vote or something and defeat or resolution, so if I say that last year only 29 resolutions were defeated, so that means the impact of investors' vote is not yet seen for the 2 simple reasons. One, not all the investors are voting. Secondly, since the promoters hold majority stake in most of the companies in India, so in institutional investors or retail investor vote has really no meaning unless until those are the transactions where the promoters are not allowed to vote. The other area where we have seen a lot of problem is when the 2 factions of promoters are fighting. So you will find that the resolution get defeated because one set of the promoter is voting against, one set of the promoter is voting in favor. So that type of things are happening. So if you take those cases out where the promoters are infighting, then the defeat of resolution is very minuscule. And the main reason is that the promoter holds so much chunk of the share that it is very difficult for institutional investor to cause any rupture.
Got you. May I ask a follow-up question then? So, have you seen instances where the resolution passes, but clearly institutional investors have voted en masse against, like, for a particular resolution, and the company had a rethink of that particular decision. Has that happened?
I would say that one case that comes to my mind is last year Vedanta had proposed appointment of Mr. UK Sinha, ex-SEBI chairman, as an independent director. Although the resolution was passed because the promoters owned 64% equity, but if you see the voting pattern of institutional investors, more than 72% had voted against appointment of Mr. Sinha. So that is one case where, but I don't think there was any rethink by the promoters of the company at all on that issue. Although they were on the verge of defeat, but there was no rethink on the issue. But I would say other case was Eicher Motor, where the resolution was defeated for appointment of Mr. Siddharth, and then the promoters had a rethink, and the resolution was brought again with a reduced remuneration, and eventually it was passed.
Got you. So I guess that's one of the things, Paul, if I have to just ask you that question, like, like in the region, I would imagine that, even if the resolutions get passed, if there is a bit of like lots of investor protest, like you would think that the companies have rethought some of those decisions.
Yeah, sure. I think that's it's one of the things that we have in the region is that we have, I mean, obviously in India, but also in China, in actually a lot of the Asian countries, we have a lot of companies which are controlled. So either you have the promoter, like the family, the state, which owns a significant share. I think what we are seeing now is that increasingly when you have a high proportion of people that are opposing a certain resolution, and even though it passes, it kind of forces the company to have a harder think about it and the issue that was at stake. And I think that's the same, for director elections, for instance, or approval rates, because it can lead to increasing kind of shareholder discontent. So it's one thing that we see more and more. I mean, it's definitely in Asia because we have a lot of control companies, but across the globe, we see more, companies having to think, harder, even though it passes for this time. And due to the structure, it may still continue to pass. But as more and more companies want to look more sustainable, they also need to kind of adjust to the feedback that they receive from the shareholders.
Right. So, so let me, move to the next topic, collaboration, right? So I think, we had a question that, what happens with acting in concert, and I said that, look, I mean, maybe what partial solution is to, you don't collaborate directly with other investors, you collaborate it through a climate action and stuff like that. So can you talk about like how you collaborate with some of these investor forums on specific topics, and what is the value of these forums?
Yeah, sure. I can start, and then if other people want to comment, I mean, if Arsha, you want to comment as well, since you're also involved in some collaborative engagement. So yes, we do either engage directly with companies. Some engagement are better one-on-one, but in some cases they are more efficient from a collaborative engagement perspective. And even from the corporate side, right? Instead of having like 20 different investors talking to them about climate change, it might make sense to have a group of investors who represent a significant share of the capital to engage together around some climate goals. So this is the case, for instance, with the Climate Action 100 Plus initiative, which aims to engage with the world's largest emitters of greenhouse gas, through which we have investors representing around, I think, 50 trillion USD that are engaging with these companies with a structure of lead and supporting investors. So typically you have 1, 2 to 3 investors which are leading the engagement, and then some supporting investors who get engaged in the involved in the preparation, in the meetings, asking questions, etc. Definitely the value of this collaborative engagement is that for some topics, particularly climate change, which really has very significant impact in the way the company is being run. If you're a utilities company transitioning from coal towards a low carbon power generation, it's a massive shift in your business model. It's a massive shift in your capex. It's a massive shift in consumer demand, regulation, and as a result, if you engage as a group, as a collaborative engagement, you have more leverage because you represent a higher portion of capital, and you also have a clearer message than if everybody engages one-on-one. So we typically see some initiatives that work pretty well in that front. I mentioned Climate Action 100+, but we are also involved in a number of other collaborative initiatives. One, for instance, in Asia, still on the climate side, is the AIGCC, so the Asia Investor Group on Climate Change, Asian Utilities Engagement Program. Because today, Asian utilities together represent around 23% of global greenhouse gas emission, because we have a very high reliance on coal. And a lot of the assets are still pretty young, so we still have a relatively kind of young kind of asset profile. And as a result, engagement appears like a pretty efficient way to try to encourage these companies to shift towards Paris-aligned type of trajectory.
Got you. Harsha, do you want to talk about the collaboration aspect?
Yes, yeah. As far as Kotak Mutual Fund is concerned, I think Climate Action 100+ is something that we have been actively participating. Although we are one of the newer entrants into this initiative, for the past 1.5 to 2 years, we have been engaging with some of the largest greenhouse gas emitters from India. The way it works is usually there is a lead institutional investor for each of these initiatives to engage with a particular company. And then there are associate investors along with that. So it's a team of maybe 5 to 10 investors who actually engage in a more focused way with some of these corporates, so that the entire focus is on environmental issues and how to bring about change and sustainable change in that sense. Yes, I mean, although early days, but the kind of impact that the investors have made to these companies, I assume, is definitely increasing, and also the response from the companies is very, very strong. So hopefully, as we go ahead, there will be more such collaborative efforts, even at the national level, not just at the international level, and hopefully that should bring about significant change overall.
Got you. Got you.
And if I may add just in a few words, one of the good things that we've seen in recent years, and especially when you look about initiatives such as Climate Action 100+, is we have an increasing representation and participation of local investors. So here, the example of Kotak Mahindra Asset Management is great, for investing in an Indian company. Similarly, we are engaging with some Chinese companies, and we have now some local mutual fund companies in China participating in this engagement, and having this dual view of not only the international investors, but also the local investors coming and engaging, I think makes it even more powerful. And even in terms of contact with the company, this is something where we've seen a lot of value in. So this is really a great trend that we've seen with more and more local investors taking part, which means that it's not anymore a kind of Western thing, international thing about looking at climate change and other ESG issues, but really something that local investors are actually increasingly caring about and involve and engage with.
Yeah. Let me turn it over to PK. Since we are talking about all these issues and collectives and so on. On your side, what are the issues that investors, whether it's institutional investors, the collectives, or other stakeholders, what are they interested in?
Sure. So I will try and answer this in few buckets so that it becomes clear. Certainly, economic matters. So in economic growth and long-term profitability matters to every stakeholder, not just investor, because at the end of the day, everybody is dependent on the growth of the company and profitability. So those are certainly the top two that comes out when we do a materiality exercise every couple of years. As far as environment is concerned, with respect to Tata Steel, what comes out is, of course, the carbon emissions, the quality of air, water consumption, energy consumption, waste management, sustainable supply chain, biodiversity. These are some things which comes out very frequently in our materiality exercise. As far as social is concerned, because again we are in a manufacturing setup, the occupational health and safety comes right on the top, because that's one of the most important priorities for Tata Steel and of course most of the manufacturing companies in this industry. Labor relations matters, talent retention matters, and of course then finally the engagement with the community around the facilities, plant locations particularly, these matter. And on the governance, what matters certainly is disclosures, because that's something which both investors, regulators, and of course proxy advisories would look for. Then of course advocacy, and then stakeholder engagement. These are some of the broad aspects that come out in the 4 buckets.
Got you. So if I have to put this ask you a specific question, so who asks what? Is it that is there a distinction between some of the groups that you mentioned, right? So potentially, let's say domestic institutional investors versus an international institutional investors. So is there is that a very neat thing that domestic institutional investors mostly focus on the financial issues, whereas say international institutional investors? So I mean that at least that seems to be like a stereotype to me. Is that how investors? So if you make a distinction on who's interested in what will you say?
Certainly, I think yes. When you really look at the mix of responses you get when you do these materiality exercises and we analyze, obviously it does tilt towards each stakeholder interest. For example, when you look at the responses from the employees, what matters to them, the top 1 or 2 will be health and safety, and the talent management, etc. So obviously that matters to them. When it comes to customers, what matters is supply chain, sustainable supply chain. When it comes to investors, by definition, first is growth and profitability, followed by of course most of the investors are talking about the ESG parameters. So you will find while everybody kind of buys into these issues, but given interests, you can clearly make out the top 2 will be what matters to them.
Got you. Let me turn over to Mr. Gupta. So Mr. Gupta, what is your opinion on the state of stewardship in India? Right at the beginning, we said that there is potentially it's important for investors to engage fully, not just in compliance, potentially all that stuff. Are there, in your opinion, areas that asset management industries really making progress? Or are there areas where you think that there is improvement to be found?
Thank you, Shiva. See, as I say, that the stewardship code has been in effect only for last 6 or 8 months or maybe a year. So what is really outcome of that? It will take time to digest. However, I would say that it is not a case that before stewardship code came into being, the investors were not doing any stewardship activity. So the only difference is that earlier those stewardship activities were happening in opaque manner that nobody was having information. Now those activities are to be recorded and reported. So that is one basic difference. The second difference is that, as Harsha said, that most of the time there is no coordinated effort of the investors. Everybody is acting in an individual capacity, except maybe a few cases in last 6 or 7 years where the entire industry came together and opposed some resolution. But as of now, it has been one-to-one stewardship action, or stewardship action which is not in the transparent manner. Now going forward, maybe 1 year, 2 years down the line, you will see that lot more stewardship effort will be there for 2 reasons. One, there is a responsibility for a mutual fund or insurance companies to report their stewardship activity. The second thing is this, that SEBI is also very active now. SEBI is monitoring activity something, and if they find that there have been some issues in the company and it is not matched by any stewardship action from the industry, then probably there could be some uncomfortable question to the institutional investor like mutual fund, that why you had not acted. So I think that thing is going to make stewardship activity more prominent in coming time. The second thing is this, that as of now, what is the role and what is the total envelope of the stewardship was also not clear. So what is happening, that most of the mutual fund, they have already identified what are the areas of stewardship activities and what is the level upon which they will act. Each mutual fund has a different level, but you will find going forward in coming 2-3 years that if there is any severe issue in any company, you will see that most of the mutual fund or insurance company would have got it under their radar and they would have acted on this, and they would have connected with the company either individually or through some other investors as well. So that is going, in my opinion, 1 or 2 years down the line, you will see a very meaningful impact.
Got you. Got you. If we follow up with this question of activism, right? So one is like engagement and persistent listening and potentially even voting and so on. But we have recently been seeing some instances of activism, some from foreign investors, some are very public, activism and so on. Do you see that Indian institutions taking a what do you call active or even escalating engagement that you sometimes see from foreign investors in coming years?
Shiva, I would want to differentiate, although it is a very subtle difference, right. Activity versus activism. Active role is a very positive aspect. Activism somehow or other, it has a negative connotation, because activism has some agenda behind it, whereas active role is not having agenda. Active role is you are playing your duty. So I foresee that lot of more active interaction will happen, active action will happen. But activist cases, since you are hinting, and I have no harm in telling you what is happening. So there are 2 cases of activism which are very current presently. One is the Invesco action against G, and other is Yes Bank action against Dish TV. Now, my opinion in both cases is totally different. In Invesco has been unable to explain to the public at large or to the investors or maybe to the other shareholders that what is their agenda, what is the outcome of their thing, and why they are doing it. Because if you see that 6 months back, Invesco was holding hand of the company and was hand in hand with the Puneet Goenka and supporting Puneet Goenka, suddenly they have turned against him. So investor would ask one simple question: just tell us what is the change which has made you turn your back to the Mr. Puneet Goenka. That is one. As far as the Dish TV is concerned, it is a very curious issue. Dish TV says that you are doing right issue to dilute me. No, right issue, nobody gets diluted. Every investor gets the same thing. So unless until you don't want to invest, so then you say, I don't want to invest. So if you don't want to invest, you can't have the company go to docs. So unless until you can certify or you can say very confidently that the sole object of right issue is not raising funds for the company, but raising funds so that I am unable to increase my exposure and get diluted. That is a very, very difficult exercise to be done. So I would say these 2 cases are more out of some different agenda rather than a known agenda.
Right. Yeah, no, it is. So I mean, when people talk about stewardship, I think eventually the discussion comes to this activism and things like that. It's interesting to hear your take on that. So let me ask Paul, on sustainability issues, right? So what are the challenges you see when it comes to engagement with companies on these sustainability issues?
Yeah, sure. I mean, so one of the the issues we can face sometimes is obviously what we discussed already with promoter-controlled companies or controlled companies in general, which sometimes may not have to listen as much to minority shareholders. At the same time, I would say that there is no like one side rule here. Sometimes you can think that some companies that have very diverse base of shareholders would listen to you much more easily. But in our engagement, for instance, with companies scoring low on ESG, scoring in our scoring, some of them are controlled and actually were extremely keen to discuss with us and get some thoughts because they were embarking on their kind of sustainability journey. Some of them, which maybe are supposed to be more investor kind of shareholder friendly, actually were not that reactive. And I think this links more to the kind of key things that we have seen is that some companies today are not so yet equipped to engage with investors. So for instance, in some cases, recently, let's say a Chinese company that we engage with, it's just one person with the IR person. And then, you have to talk about climate change or biodiversity or like some topics with that person. And even though that person wants to do, his or her best, it's kind of stretches very far. And what we talked about, I think, a lot in this panel since the beginning is also how sustainability needs to be integrated in the firm's strategy. Let's say if you talk about climate, it's not an investor relation exercise. It's really something that needs to be integrated at the strategy, and that's something that also Arsha has probably seen, in the engagement through climate action. The things start to change from the moment on that the leadership of the company is really embarking on that strategy. It is not a kind of greenwashing or brand building exercise like communication exercise. So I would say the main kind of hurdle that we face is companies that are not set up yet, but we have seen some companies where there is just this IR person, but then the CEO says it's very important for us, and then starts to hire a sustainability department, starts to put responsibility for sustainability in different operational department. And I think Piquet probably has this experience within Tata Steel, where there is very good management of some of the issues that Piquet talked about health and safety, human capital management, etc. So I would say this is probably the main challenge that we face is when companies are not prepared or set up to engage with investors.
Got you. So let me ask PK. I think that's a good segue. So he talked about IR, right? So can you talk about what are the various channels for engagement with institutional investors? I suppose IR is one, but there are many. And I think to Harsha's point, do you reach out to its investors on one-on-one engagement on specific topics?
Yeah, so I guess the channels are pretty much standard because as a listed entity, we do come out with earnings release every quarter. So there is going to be a quarterly earnings release call or a meet, and where everybody is present, and of course that's recorded. The transcripts are out. Apart from that, of course, there is Investor Day. It's a good part of the day that we engage with investors. Again, that's made. That's disclosed, that's kind of beamed live so that people can look at it, so that there's no asymmetry of information between investors and people who are participating. We do, of course, we do engage in one-on-one discussions, and that disclosure is also out in the public domain, and that's anyway more now driven by the SEBI regulations. But just to kind of articulate the legal position here, what companies generally do is they actually don't speak anything which is price sensitive, or they don't give out any confidential information in many of these meetings, because most of us are bound by the fair disclosure norms. So either you speak about the information in an open investor forum, or you speak about it in the quarterly releases. What you typically do in a one-on-one meeting is you try to repeat what has already been told, or you keep the narrative within the boundary that's already available in the public domain. So that's what happens typically. I don't think any company or any investor relations person or any CEO or a CFO would typically end up speaking which is outside the boundary of what's already available in the public domain. Because the moment you kind of give out information which is not within the public knowledge, then actually the asset manager who is privy to that information becomes an insider, and then he will not be able to trade. So he's bound by all of the policies of the company with respect to insider trading. So I guess even it's in the interest of the asset manager to make sure that the person who is attending the meeting doesn't hold any information. Otherwise, they are stuck with the obligations.
Yeah, that's right. Yeah. So let me, go back to Harsha, and so maybe let's talk about proxy voting. I think we spoke about some of these things briefly. So can you talk about general decision making process, right? So one of the issues we said is asset managers think about what is in-house, what is how much of reliance on third-party proxy advice that you have. So can you talk about generally how that distinction is made, right? So how much is outsourced, how much is in-house, and how do you make the distinction? Maybe even talk about how do you resolve let's say a challenging proxy voting decision?
Yeah, Shiva, if you look at proxy voting and investments, I think in both cases you get third-party advice. But in both cases, the investment firms will also have their own opinion, either through their in-house research or through discussion amongst investment professionals inside the company. So to that extent, for us, the proxy voting advice is also similar to the brokerage reports that give investment advice. We may or may not use that for our decision making, or we may use part of that report as input to our decision making. So I think the end of the day, it's one of the inputs that we will definitely consider, but whether it will be binding on us, the answer is no. And this varies from investment firm to investment firm. There are many investment firms who simply go by a particular proxy agency advice. But in our case, we have decided to keep it open so that there is an active role of in-house research team as well on these matters. That's how we have been going about it. As far as voting issues, I think Mr. Gupta has already mentioned a couple of areas where generally institutional investors have kind of opposed or gone against the resolutions which are in nature of excessive remuneration for professionals or the promoter family. Maybe in some cases it's related to ESOP. For example, we have also opposed a couple of resolutions in a few companies where the ESOPs were being given at a very significant discount to the company. The way we look at it is ESOP should be used to actually energize the senior management or whichever part of the workforce that you want to incentivize. And it has to be more equitable, and it should be linked with the future growth of the company and not on what has already been achieved. For example, if you try to give shares at face value when the company is already trading at, let's say, 1,000 rupees, that's not a fair way of giving remuneration to executives. It should be linked from that particular point of time, how the company does over the next few years. Similarly, there were a couple of cases where material related party events took place or were going to take place. So those are some things which institutional investors are always worried about. For example, it could be a company which has a multinational parent. You could be using some sort of a R&D inputs, technical know-how, or maybe just the brand of the parent, etc. So what kind of royalty is right on optimum is something that one needs to take up on. Some of these, obviously, it will differ from each investment firm to another investment firm in terms of what they think is fair. But all of us, I believe, will have a certain level of optimum level in mind. And as long as it is below that, then I think the opposition will be less. But if it is very, very different than what market practice has been or what the company was doing in the past, etc., then there could be a lot more questions. Those kind of voting decisions become challenging.
Got you. Got you. So Paul, if I can quickly, take your opinion on proxy voting and so on, right? So I think are there places where you're saying like, look, stewardship efforts are not yielding results? Like I think you talked about challenges, right? So like if we are going to use the proxy vote, or like we are going to sell it, can you talk about what's the general process for escalation?
Yeah, sure. So I would go back here a bit to the different types of engagement that we have. So definitely our kind of approach is that whenever we think that there is scope for positive impact, we prefer engagement rather than exclusion, right? We have different types of engagement. So some of the engagement are related to our proxy voting rules ahead of a vote. So for instance, we have some expectation around board gender diversity, or independence of the board, or financial expertise of the audit committee. So we have a number of elements here. And let's say when we contact the companies towards their board gender diversity and they're not in line, then we would vote against any director, male director, that is up for election or re-election. So this is just, we have some very kind of simple, standard, like well set in stone kind of rules. But however, we had the case of an Indian company, for instance, which we contacted, that is not in line yet with our expectation, but where the chairman actually committed to align within 2 years with our expectation, the time basically to find the suitable candidates. And we don't want to, force the company to appoint anyone, right? We want to for it to be done in a very efficient way. When we have some engagement with companies that are scoring low on ESG, where we have identified some environmental, social, governance weaknesses, and we want the company to address it, then we have a kind of 1 year timeline where we initiate the engagement. We see how reactive the company is. And if they are not, and we have some issues that we are really concerned about, potential red flags, then it may lead for us to divest. Then when we have cases of companies that may not be in line with some of our sector policies, or not be in line with the UN Global Compact, for instance, have maybe some major environmental issues or human rights issue, labor rights issue, then if the engagement is unsuccessful, that may lead us again to put the company on our kind of exclusion list for being non-compliant with our policies. In terms of the broader engagement on different themes, such as climate change, we will look at different options if the kind of initial dialogue is not yielding results, which can include some statements, which can include even going to filing some shareholder resolution. So we filed a shareholder resolution at Exxon this year again, which received majority support around climate lobbying. And basically here we would be looking also to support any resolution that is in line with our objectives. So any shareholder resolution around greater climate change disclosure, a more ambitious climate transition plan that still is in the interest of shareholders, we would support it. So we have a range of different kind of stewardship tools that we can use in case the initial engagement is not successful.
Got you. Can I turn to PK now? And we talked about challenges in stewardship from asset manager perspective, right? But what are the challenges, practical challenges, when it comes to stewardship and engagement from an issuer perspective?
So as far as the issuer is concerned, as I said, one of the challenge, frankly, is when you are speaking to particularly analysts or asset managers, you must be extremely careful not to breach the fair disclosure norms, because that can lead a listed entity into a big trouble. Particularly, SEBI has been extremely active in terms of prohibition of insider trading. So that's more a legal and governance issue. If you look at the strategic challenges that you would have, some of these sustainability aspects, some of these societal aspects would need a lot of capital. I mean, while it's nice to be talking about this, it needs a lot of investments, and you are actually making the decisions for the next 30 years to 50 years. So you are actually taking decisions today with suboptimal information and committing capital and resources. So it does lead to a lot of challenge, and you will need a lot of support from your internal stakeholders and external stakeholders. So to balance, if you're an issuer and if you're a management, you are always kind of tied between the short, medium term goals to the long term goals. So the incentive structures have to align so that there is enough and more incentive for the management to look beyond 5 years, beyond 10 years. And at the same time, the external stakeholders have to also give that kind of leeway and have patience to allow companies to invest into the long term and allow the results to or the outcomes to unfold. If these don't align, then it will be very difficult for management to commit for that long time, because many of these stewardship matters are long-term structural matters. They are not short-term minor interventions. These are very, very structural. So I think from a market perspective, from stakeholders' perspective, everybody needs to align their expectations. That's when all of this will work.
Okay. So let me turn over to Mr. Gupta. I'm interested in hearing your thoughts about your own engagement with companies, so to speak. So SEBI laid out procedural guidelines for proxy advisors, and it says that you have to, like, there is a process for including comments from companies, right? So when you put out recommendations and so on, it kind of came, I don't remember, the beginning of the year, if I'm not wrong. Can you talk about how is that process working in practice? And from your perspective, are there any issues that you want to highlight?
Shiva, many years before the SEBI guidelines came, SCS, that is my company, has been following what has been mandated by SEBI now. So right from beginning, we had a blackout period. Ever since the notice of the company is released, we don't interact with the company till our report is released. Only after our report is released, we interact with the company, and we had a policy that whatever company sends to us, we publish an addendum to that report, and in the addendum, we reproduce religiously what is the communication we received from the company, and then we highlight our counter to their points. That is one part. But what earlier there was no timeline. SEBI has mandated timeline and say given 48 hours to respond. Now many a times it may happen that 48 hours is very short period given the bunching of AGMs. So what SCS has done is this: SCS immediately, as soon as we get any response from the company, we send the response as it is to our clients, so that our clients are aware what is there. But then we try to issue addendum within 48 hours. Many companies, after our report is released, want to have a call with us. We do have a call. If the time permits, we discuss. But we request all the companies to keep the recording of the call. Because if the call is initiated by us, we keep the recording. If the call is initiated by the company is asked to keep the recording, because we don't want to lose any audit trail. But we find that the practice all across the industry is not safe.
Okay, got you. So, but otherwise, like this whole thing, how do you view this rule as such? Right? Does it give an opportunity for company, or do you think that it just adds a layer of complexity to your research process? Right. So, what is your opinion?
No, I don't see it adds any complexity to our research process, because our research is in any way independent of company comment. We invite company comment only after our research is complete. So the company only writes to us if they are not in agreement with our comments, or they want to add something. And that is how the whole thing happens. So it is not adding to any of our problems. So On the other hand, it has made very well known to the company that if they want to counter our opinion, they have the window available.
Okay. All right. I think we can probably continue this for a long time. I think there is like lots of fertile topics to explore. But I think we are at the hour, and I do want to be mindful of our audience's time. So thank you so much for panelists who joined us, who kind of like had a spirited discussion on these issues, and all the questions and follow-up. Thank you so much for our panelists for joining us today. It has been very insightful.
Thank you so much.
Thank you so much.
Thank you.
Thanks a lot. Thanks, everyone.
Right. So that brings us to the conclusion of day one of our conclave. Tomorrow, it's like I said, there is a strong regulatory focus. So we have the SEBI, from SEBI, Sri Ananta Barua talking about the India's stewardship and the importance for stewardship for SEBI perspective. We'll also have David Stiles and Paolo from Financial Reporting Council talking about UK stewardship journey and what is the state of stewardship reporting and what do they see as challenges as well as best practices. And NISM will present some research, their research on Indian stewardship practices. So they have some, they have months of data. They will present some research findings as well as some recommendations and way forward. So that's our agenda for tomorrow. I very much look forward to seeing you tomorrow, and thank you all for joining us today.
Okay, thank you, Shiva. With this, we are coming to conclusion of this wonderful one-day arbitration conclave on stewardship. So thank you so much. Dear participants, we look forward to seeing you tomorrow and engaging you tomorrow. Thank you so much. Bye-bye. Have a wonderful evening. Bye.
Thank you. Thank you. Bye-bye.